Okay, dear students, this is Mustafa Mirchawala from Mirchawala Sep of Accountancy, and I am recording one past paper of SBR for you guys on the request of students. But what's my approach is, I will just walk through this question. I'll give you tips for this question, and then you will have to solve this question formally and send me for the checking purpose. Okay, obviously the checking facility is for only for registered student, but you can send me, you must send me, all registered student must send me, so I'll give you proper feedback, right? Okay, now this is basically question number 3 of the latest past paper available on the accglobal.com of SBR. It's a September-December 2022 attempt. Now the first part is related to IFRS 15, and it is connected to F7 level as well, FR level. These issues we teach in FR level as well. If you have read the book, you must have seen this issue. But obviously, it's also connected to SBR. Rubel Company is a group which manufactures furniture and currently preparing financial statement for the year ended 31st December X7. This is your year end. Okay. The following exhibits available on the left hand side. Now, this is the first point, which is consignment arrangement, which is linked to IFRS 15. IFRS 15. Now, describe the sale and dispatch of garden furniture to garden centers and its inclusion in financial statement. Okay, so let's start with this consignment arrangement first, that IFRS 15 issue first. Okay, it's easy, it's not difficult. You need to decide, you need to discuss whether you need to book revenue, when you need to book revenue, basically. Okay, now or later. Rubel Company provides garden centers with furniture on a consignment basis. Now wait, what does it mean? In my basic classes, I have discussed this issue on Toyota Company, on showroom business. Like, Toyota Company, let us say, just think, Toyota Company or Honda Company or Ford Company just supplies car on the showroom. They deliver car on the showroom and they tell the showroom owners that, okay, keep these cars. And when it is sold, when these cars are sold, you can pay us. Okay. So this is basically the consignment basis. This is sort of business. So in this question, we are Rubel Company, and the other showroom, the showroom party is garden centers. The name of our customers are garden centers, and we are going to deliver them furniture, and we are saying them, okay, keep these furniture, and whenever you sell it, just pay us. Okay, right? So it's a sort of a slight touch of sale or return basis type of thing. Okay, so you need to think about it, that whether, listen to me, we have transferred the control from day one to them or not. If yes, we have transferred the control, then we can book the revenue immediately, otherwise we can't. Okay, let's see. It's like a case. You need to act like a lawyer. You need to build up points, arguments, as you should. Rubel Company retains legal title. See, this is the one point. This is the first point, that the legal title of the furniture until they are sold to customers. So that means, when you have legal title, that means you have control. So this first point is in the favor that you have not transferred the control. This first point is in the favor that you have not transferred the control. And when you have not transferred the control, then it means you cannot book the sale. So first point is going towards not booking the sale now. Now, until they are sold to customer, the products are immediately available for sale. They are on delivery to the garden centers. Yes, they are ready to sell. That's ready-made products. The garden center does not have any obligation to pay Rubel Company until a sale to customer occurs. Very, very important point. That means in reality, see the economic reality. If garden centers, our customers, if they sell it to the customer, then they will pay. Otherwise, there is no obligation. That means they don't have any unconditional obligation to pay. They don't have any unconditional obligation to pay us. That means it's not sold. Or I can explain you in a very good way. This line also means, see the highlighted line also means that risk and reward also not transferred. Risk and reward also not transferred. giving you one example. For example, let us say we have delivered the furniture, and at that time the value of furniture was $1,000. At that time the value of the furniture was $1,000 at the time of delivery, but it is sold after 3 months. Let us say it is sold after 3 months by garden center. So if the market value of furniture goes down in between these 3 months, like because of anything, market changes or anything, any factors, so now this product will be sold for $700. So now garden center will give Rubal company only $700. So that means whatever the price drop is to be borne by the Rubal company. So that means Rubal company is bearing risk and reward. So we can say that at the time of delivery, at the time of first delivery, Rubal company has not transferred risk and reward. So again, we can say Rubal company cannot book the sale. This is very heavy point. Okay. Now, physical possession, only this thing remains with the garden center unless the furniture is sold or returned to Rubal company. That means they have right to return as well. See, they have right to return as well. This point also goes in the favor that you cannot book sale. Rubal company also retains one more very important point, also retains the right. We are Rubal company, right? Any unsold furniture returned to them or to transfer unsold products to another retailer. This is the real power. See, they can exercise their power as well. What does it mean? If Rubal company, we are Rubal company, if Rubal company wants to transfer that furniture to another seller, they can just give us instruction and the garden center has to follow. So once again, the control is with Rubal company. So when the control has not yet been transferred, then Rubal company cannot book sale. It's very easy, very obvious points. Okay. So once the garden center has sold the furniture, Rubal company has no further obligations. This is about stage 5. That means the revenue will be booked point in time, right? Once it is sold, then the Rubal company is no more responsible. So in previous classes, in my normal lectures, I have discussed this thing, that whenever you give product and then you say bye-bye, so that means you need to book revenue point in time. Okay. The garden center then remit to Rubal company the sales proceeds net of their agents commission. Now, very good thing. See, now you need to discuss in 1 or 2 lines like that we need to listen. We need to reassess this whole scenario, that whether we are principal, Rubal, and they are agent. If it is proved that the garden centers are agent, so whatever commission they will deduct will be our expense. Commission is expense for us. Like for example, I'm telling somebody to sell this pen for me, and I'll give you 10% commission. So for the other party, that commission is income. For that other party, opposite party, commission is income. But for me, commission is expense. Simple. So what I will do, if I am a principal, I will book the gross revenue. I will book the total gross revenue, and in the bottom line, after gross profit, I will be booking the commission expense. Okay, if it is proved about the agency relationship. And if it is not proved, then obviously the net amount of receipts after deducting commission will be my gross revenue. Okay, but again, the about agency relationship, there are no further information is given, that who is responsible for returns and who is responsible, what are the powers of agents, what are the issues with agents. The more data is not given. So you will just discuss it little bit, like both scenarios, that if this is the agency relationship, then Rubal company will be booking gross revenue, and after gross profit, they will be booking commission expense. And if there is no agency relationship, then definitely Rubal company will be booking net amount as a revenue, right? Rubal company has decided to include Rubal company Okay. Rubel company has decided to include the sales value of all furnitures delivered to and held by. No, not acceptable. This is wrong. Wrong. You need to challenge it. Okay. Wrong. This is against IFRS 15. Against IFRS 15. So I would say this was a good question, and this is scoring question. This part was a scoring. You can easily write like I have discussed many points, and you need to put up the case like this, and also finally you need to discuss about the stage 5 point in time. Okay, so you guys can do it. Even you have done this in your basic studies. Even if you have read the book study text of F7. Normally, when I teach FR level, I recommend many times to read the study text as well. So in this case is in the study text of F7, the basic paper as well. I hope you got it. I hope you got it. Have a look, read it again. Okay, now the next thing is second issue is provision for tax liability. Provision for tax liability. We all know about IS 37. Go very simple. In IS 37, to book a provision, you must have three conditions: present obligation, probable outflow, and reliable estimate. And I think the first one is very important, that the present obligation must be there. Present obligation, that means obligating event has arisen, right? Or that means we can say, and there are two types of present obligation. It's constructive or legal. Constructive, it's constructive or legal obligation, right? Okay, now let's start. Rubel company has shipped and sold goods in an overseas country for 10 years. They are selling goods, they are doing export, like it's export. Okay. Rubel company was under the impression that the sales in overseas country are subject to sales tax if if the company had a physical and economic presence in the country. Now, we as a Rubel company, we were thinking that we are exempt from sale tax because we are not physically there. We are just doing export and we are not physically there, right? Okay. Now, Rubel company had always understood that because it did not have a physical presence in the country, it was exempt from the sales tax. That was our perception, and that's why we were not paying for sales tax since years. We were not paying sales tax in that country. However, now the game changed. However, the tax laws stated that companies were subject to sales tax if they had a physical, or read the word, or economic presence. Yes, we have economic presence. We are earning from them. Therefore, at 31st December Act 7, Rubel company has realized that a liability for sales tax has existed for previous 10 years. Now, this is very simple, clear-cut discussion. Just think over it. That means according to, don't read next paragraph, just think, according to IS 37, we have obligation. Because we have already, hope you remember my previous lectures, you have taken the classes. We have already performed the act, present obligation is there. Why? In this case, you have this much knowledge of sales. Whoever does sales has to pay sales tax. So yes, in last 10 years we have done sales, we have sold goods. So there is an event. With sales you have to pay sales tax. With sales you have to pay VAT. So the sales has already been earned, sales has already been done. So that means you are you have to pay sales tax at any cost. So it's obligation for you. It's done, right? And the second thing is probable chances. Yes, full-time probable chances, full-time probable chances. Why? Because there is a law. Sales tax all over the world is a normal thing. Whenever you do sales, you have to pay sales tax. So yes, according to IS 37, we have to book provision. Yes, there is one point, the third point, reliable estimate. You can discuss, you can comment on this point. There are issues that last 10 years, there is a possibility, although now it's not difficult because this is the age of data. So normally company keeps data of last 50 years as well. Now it's easier to keep the data. It's all electronic. Okay, so you cannot excuse. So in the last point, that is reliable estimate, you can say, in the last point, that is reliable estimate, you can say that if the reliable estimate is not there, then you need to use the judgment and you have to go for the best estimate amount. Okay, so in the last point, you can play up to a certain level if there are exceptions. Okay, now Ruble company listen. Ruble company has never Ruble company has never collected sales tax or filed sales tax return in the overseas country. Ruble company has never been contacted regarding sales tax by the tax authorities in the overseas country. No, wait. This is not the fault of overseas. There is a very famous dialogue uh, about the law, that the ignorance of law is no excuse. Very famous quote. Hope you ignorance of law is no excuse. It's like I'm driving and I don't know the rules of driving and I kill somebody. So will the police leave me? No. Why did I sit on the driving seat if I don't know the law? This is my obligation. I have to learn about the signal, what is green, yellow, red. So ignorance of law is no excuse. This is the basic common sense. And you guys are in strategic level. You guys are strategic level students. So don't come in the dodge of examiner, right? If it is written that we have not collected sales tax, why would we give to the government? That's our fault. That's not government fault. That's not government fault at all, right? Okay. And second, Ruble company has never been contacted regarding sales tax by the tax authorities. So that means, because we also didn't go to them. Sometimes we don't come under the eyes of tax. It is possible, but yes, whatever sales we have done, there is a law. There is a law there. See, it is written. The law stated that we have to pay. So yes, obligation is there, and you have to book the obligation at any cost. So these two lines are of no weight. Ruble company therefore considers that the risk of detection by the taxation authorities is very low. However, if the taxation authorities know about Ruble activities, it is probable that the Ruble company would be liable for uncollected sales tax, interest, and penalties. Do you think we should use such excuse in line number 3, that the tax department is sleeping, so don't pay tax? Is it ethical? Is it ethical? Is it legal? Is it professional to think like that, by to not booking the liabilities by making this excuse that the tax department is sleeping, they can't detect us? No, not at all. There is no such excuse in IFRS. Right now we are doing IFRS question. It's not current issue question. It's a pure IFRS question. IFRS simply says, if yes, there is an obligating event and if you are liable, you have to book. That's it, simple. There is no such thing that you think about other parties. that they can't trace us. No such excuses are there. No such excuses are there. So again, this third line is a dodge for you. You need to be very straightforward in liabilities. Even let one thing just click in my mind. Hope you remember that IFRS board is very sensitive about liabilities. Liabilities are obligations. If you hide your liabilities, if you hide your real obligation, that means your financial statement will look good. So it comes in the manipulation, it comes in the window dressing. Remember financial instrument lecture? In financial instrument, we teachers normally discuss this issue that people intentionally, accountants intentionally reports liability as equity. They try to hide liability. So if you hide this liability by making such excuses, this comes under window dressing. Okay. However, if the taxation now, so that means what we would say, yes, we have to book complete amount of sales tax, we have to book complete amount of penalties, interest, everything. This is payable. Ruble company consider the tax authority would settle for an amount less than the full liability if full disclosure was made as it is now, as it is widely understood. See, examiner has written in inverted commas. So we need to discuss it, that the taxation authorities would look back no more than 7 years to determine the amount of sales tax due. The tax authorities can reclaim any sales tax liability from prior years. Now we are saying, this is full disclosure. If you have studied F6, because I also teach this taxation paper, so I teach this issue that whenever you disclose voluntarily, whenever you disclose something voluntarily, tax department normally waives your penalty or they reduce your penalty if you go them and voluntarily disclose. So yes, this is a topic, and if it is, and that's the part of law. That's the part of law proper. So in reliable estimate, you can refer, listen, you can refer to the law, the points of law, that in case of full disclosure, how much discount we will get. And if it is sure that you will get, then you can incorporate that discount. Otherwise, the word widely understood means this is the people saying, this is the market culture, that they normally say that tax department agrees. Like in Pakistan, they say no need to pay tax. Sometimes they say we can handle. The lawyer says, the tax consultant says we can handle. So, but still, accounting standard does not accept all these words, we can handle and all. Listen. So in the answer, you need to comment on this. See, this word is important. I have also highlighted, and examiner has written in the inverted commas. So you need to discuss the word widely understood, that what is the meaning of widely understood? Is it something which is backed up by law or not? It is something written or backed up by law or not? If it is not backed up by law, then you cannot reduce your liability by using such words. Okay. So it is written that tax authorities cannot look back no more than 7 years. Although they cannot look back 7 years, more than 7 years, but still we did the sales for last 10 years, and the law says with the sales you need to book liability, with the sales you need to book liability. So in that case, you need to book complete liability. You need to book complete liability, but still I would say about the disclosure thing, if that disclosure thing is confirmed as written by law, then you can play with the last point, and that is reliable estimate. Because in provision, there are 3 points: present obligation, probable outflow, and reliable estimate. One thing which you all must be thinking about, and I'm sure we all have to discuss, and that is IS 8. In this part, don't forget IS 8. Although, sorry, the name of IS 8 is changes in accounting policies, changes in accounting estimates, and prior period errors. Although this is linked to provision, I agree, but we did this error, we did this mistake in past, and it is discovered now. We did this mistake in past and it is discovered now. So it should be adjusted retrospectively. It should be adjusted retrospectively, means in opening retained earning. Okay. And one more thing you can say that it's all about present obligation is all about past, right? For future sales, you don't need to book any provision right now. For future sales, you don't need to book any provision right now. Okay, whenever in future you will do sales, then you have to book the liability for that. Okay, so I think I have done discussed many points, and you guys can send me those points. Read it, please. Now, this is income tax. Income tax, easy part. Easy part. On 31st December X7, legal proceedings were started against Ruble by the tax authorities in the same overseas country for unpaid income tax. It's not about sales tax, it's about income tax now. Okay. Ruble company disputes the fact that it owes income tax as it has always paid tax on time. So, see, there is a conflict now. The tax authority is saying that you have not paid the tax, you earned it and you didn't pay the tax, but we are saying no, we have paid, we are sure this is just your mistake. We are saying tax authorities that you guys are mixed up. We are clean, guys. Okay, so now wait, if we are culprit, just think case number, if we are culprit, then yes, we have to book the provision, because in past, first of all, there is a present obligation. Yes, in past we have earned the money, and on earned money you have to pay tax, so it's an obligation. So if we haven't paid the tax and the tax authorities are coming to us, we need to book the liability, if this is the case. But things are different in this regard. Ruble company considered that it is just a coincidence. It is just a coincidence that these proceedings have commenced and does not relate to the sales tax issue. It has nothing to do with the sales tax. Forget it. Ruble company considers that there is a little chance of the income tax case succeeding. In any event, Ruble company considers that it cannot measure any potential income tax liability, as it is, or its opinion, none exists. Now, there are many points. 3 points: present obligation, probable outflow, or liable estimate for IS 37. First of all, the tax authorities are saying that we have not paid the tax, but we are sure. See, they are saying we are sure that we have paid the tax. That means in this part there is no surety that there is a legal obligation. So first point already in doubt. The second thing is called probable outflow. The chances of losing the case, the probable outflow. See, it is written here clearly, there is a little chance of income tax case succeeding. That means whatever case income tax authorities filed against it, they won't succeed. We will succeed. So that means there is a very less chances of outflow, like it's possible or something, not probable. Okay. And one more thing, Ruble company considered that it cannot measure any potential income tax liability. That means the reliable estimate is also not possible, because things are very gray. And it's not a clear-cut case. So on the basis of all these evidence which I just discussed, we will say that no more provision for this transaction. Yes, we can book a contingent liability here. We can book a contingent liability for this paragraph. See, this is the latest past paper. This is latest past paper. It's a normal person can easily discuss it. And this is not any advanced standard like IFRS 9 or IFRS 15 or no, it's IS 37. And you have done many past papers. Why can't you do it? You have read many articles, lot of classes you have taken. So it's just, you just need concept. You just need to give the message to your mind that you are good. Read the requirement, please. Read the requirement. Now only one paragraph is left, which is the easiest. Now, the last paragraph is linked to IS 21, effects of foreign changes in effect of foreign exchange, IS 21. Listen, first of all, learn the basic rules. The first thing is, if you have a monetary asset or monetary liability, that means you have cash, you have a bank balance in foreign currency, or you have a receivable or payable in foreign currency. So the basic rule says initially you need to book at the exchange rate of the transaction date, and later on at the year end or at the time of settlement, if there is any exchange gain or loss, for monetary items, exchange gain or losses are to be booked in P&L. Monetary items, exchange gain or losses are to be booked in P&L. Very simple. Okay, this is the basic rule. Exceptions are always there. This is the basic. And one more thing, if you have a running business outside your country or in any other country, you have invested in any other currency, you have invested, like you have a subsidiary. So in that case, it's like a foreign operation. So you need to apply detailed rules of foreign subsidiary consolidation, which you have done. For sure, you have done in consolidation, many classes. And in that case also, you need to book exchange gain or loss. And that exchange gain or loss on foreign operation must be booked in OCI now. That exchange gain or loss on foreign operation must be booked in OCI now, and later on, when you sell that foreign operation, they will be reclassified to P&L. Okay, these exchange gain or loss of foreign operation, they will be reclassified to P&L. This is the basic rule, and thus, yes, in state the rule, you need to discuss it. Now, read the question. Ruble company has substantial deposits in currencies other than its functional currency. That means other currency, right? Okay. So these are deposits. Deposits are monetary items. It also has a number of overseas subsidiaries, foreign operations, where the local currency is used to prepare the financial statement. That means that subsidiary's financial statement is in different currency. Okay, like we are in dollars, they are in dirhams. We are in dollars, they are in dinars. Same the case which you have done, which are then translated into presentation currency under IS 21, effects of changes in foreign exchange rates. These countries often suffer fluctuations in exchange rates. Now, I see, I've made many short videos on SBR exam approach. And I have discussed many times that whatever happening in the world, they just test you. See, this is the real life issue. If you see the 2022 years, many countries face this currency fluctuation. Even UK, if you see UK pound, there was a huge depreciation in UK pound. You see Pakistani rupee, even Indian rupee got depreciated up to some extent. You see the Bangladesh currency, many currencies got affected, right? So see, they are being tested. This issue is being tested. So whatever is the real life issue, it may come in the exam. So now what is the problem? The problem is that there is huge currency fluctuation. So it's very difficult to do accounting. It's very difficult to do accounting, and it's very difficult to report such losses or something because shareholders are not satisfied or something. So Ruble company decided to eliminate the effect of exchange rate differences and presented financial information using a single historic fixed exchange rate for the translation of the international subsidiaries, which is not updated between periods. No, not at all. This is at least not allowed by IFRS. Otherwise, we wasted our time. We invested 2-3 classes on this foreign exchange, obviously. So just think as an investor, as an owner of business. Listen, you are in United States and you invested in Pakistan today. The exchange rate was $1 is equal to 100 rupees, for example. Now, after 3 years, $1 is equal to 300 rupees. So because of this exchange, big fluctuation now. So now if you sell your business, so you will get very few dollars. If you sell your business in Pakistan after 2 years and then you convert it into dollars, you will get very few dollars. That means there will be a huge exchange loss. There will be huge exchange loss. So yes, this loss is relevant for shareholders. As an owner, this is very relevant. As an investor, this is very relevant. So if we use just the historic rate and we don't update the exchange gain or loss with the latest exchange rates, so shareholder won't get the information. Or I would say one thing which you have to write in the solution as well. We need to show them the breakup. Listen, look at here. For example, hope you can understand. When foreign investor came to our country, the exchange rate was $1 is equal to rupees 100. Let me explain. $1 is equal to rupees 100. Okay, this was the exchange rate. Now after 2 years, $1 is equal to rupees 300. Okay, and the foreign investor, obviously, if he has invested in Pakistan, so he invested in rupees. So now if that investment grown to rupees 200, he invested rupees 100, and now the investment, obviously the value of investment may rise, so it's 200, but $1 is equal to 300. So overall that foreign investor is in loss. Overall foreign investor is in loss, because now if he converts this rupees 200 into dollars, so he will get even less than $1. He will get even less than $1, and this is the biggest reason why in Pakistan foreign investors are not coming, because of huge uncertainty and huge exchange losses. Are you getting the point? So it's a very good approach by IFRS to break up the difference between, to show the breakup of whatever the real earnings, whatever the real performance, and what are the exchange losses, and then combined effect. So this is very good if you report this thing. So now in this part, you have to discuss this issue. You have to explain to examiner this issue, and this is very easy, about the real earning and the movement of exchange gain or loss. One more thing about, obviously, you have to discuss that in the few lines of foreign subsidiary consolidation, that according to IS 21, the assets and liabilities at the year end should be translated using the closing rate exchange rate, all of you know. And for income statement is a for the year thing. They have allowed us to use average rate, right? You used to retranslate the income statement using average rate. Okay, and finally you have to tell them that we have to report exchange gain or losses on net assets and all. because whenever you buy running business of any subsidiary, you basically buy net assets. So exchange gain or loss on net assets is very important, right? You have to write, you have to explain, or you can explain one more thing. For example, company earns profits. So let us say our nominal profits went up by 10%. Our nominal profits, like in rupees terms, your profits went up by 10%, but there is a currency depreciation of 20%. So that means in reality, we are not good. In reality, the foreign investor is in loss. So you can also give this example in your solution like this. Okay, getting? And then finally, you need to come about the deposits. See, don't forget this line about deposits. You know, deposits are monetary items. Now go slow. I have already discussed, but again, I'm telling you, deposits, cash deposits are monetary items, and monetary items initially recorded at the exchange rate of transaction, and at each year end, they need to be retranslated. And exchange gain or loss are to be reported in P&L. Exchange gain or loss of monetary transactions are to be reported in P&L. Now I'm telling you one new exception. Look at here. And that exception is if there is a currency which is very uncertain and very shaky. Listen, like it goes up 10% today, and next day it goes down 12%. It goes up 10% today and then 12% down. Giving you one example, very real example. I made a short vlog on it today. Like, recently in Pakistan, there was a famous politician got arrested. So when he was very famous politician, so the day he got arrested, the exchange rate was 283. And because of that political unrest, exchange rate went to 299 on the same day or within 30 hours, right? And when the government released that politician, the exchange rate came to 285 again, 299 to 285. So now just think, it's movement, it's 5% movement. And if you know the international rules, if you read international news, 5% movement within 2 days up down is a big thing. So normally foreign investors don't trust. This is dangerous, very dangerous. 5% movement in currency in just 2 days. So now, listen to me, now come to the IFRS. IFRS are flexible. You guys know IFRS are principle based. They are flexible. They give you option to do accounting in a relaxed way. So if you have invested in such a country where there are such movements up and down, so now standard allows you to book exchange gain or loss of monetary item in OCI, so that you can protect your P&L. Because these gains or losses will be reversed soon. These gain or losses are not permanent, they are very temporary, and they go up and down, so they will be reversed soon. So now you can book an OCI with the permission of auditor. Definitely auditor is there, so that you cannot misuse this point. But again, I would like to say one more thing. If you are using this exception, then you need to use disclosure as well. You need to disclose things as well. You have to inform shareholders properly, right? Okay, so I hope you understood it. So now I have a request that you guys write this question properly and send it to me on that email ID which I have given you, right? It's for definitely this facility is for registered students. Hope you understood it and hope you are confident. Hope you are going to score good marks. Thank you and take care. Allah Hafiz.